we'll be going over IRS Form 2210, Underpayment of Estimated Tax by Individuals, Estates, and Trusts. So we recorded this in early 2023. I wanted to update this video for the tax year 2023 and to incorporate some of the comments and questions that have been asked over the past year. So there are three parts to this tax form. Let me briefly outline them. In part one, we'll calculate the required annual payment. This will help us determine whether or not we've paid enough tax throughout the year, and then help us determine whether or not we need to continue with the calculations for any penalties for underpayment. In part two, we would check the applicable reason why we may be filing. If there's no reason that would apply to our situation, then we can just completely not file the form. And then in part three, if we need to, we would use this section, this part to first figure out the underpayment for the tax year for each period of the tax year. And then in section B, calculate the penalty. So this is a fairly tricky form. If you're using electronic software, fortunately, it does the vast majority of the work for you. I'll walk through the calculations as we get to them, and then you can kind of understand. Really quick, because I've shot this probably about 5 times, and this is my 5th or 6th take. If you do see any errors in the calculations, please point them out in the comment section, and I will make sure that I incorporate them into the show notes. So if you're watching this video, please take a look at the show notes to see if there were any updates to the calculations. This will be a pretty long video, and instead of re-recording based on a mistake at minute 26, I'm simply going to incorporate any mistakes and edits in the comment section. So if you do find a calculation, if you could specify it and put like a timestamp of approximately when that calculation should have taken place. If that's a calculation that impacts the rest of the form, then I will probably end up having to reshoot this video. So hopefully it doesn't happen. Let's go ahead and begin. So at the top of the form, we have our hero's information, John Doe, his social security number, and at the very top, there's a flow chart that kind of asks leading questions about whether or not you have to file IRS Form 2210 in the first place. So as a general rule of thumb, if your total tax liability or your outstanding tax liability is less than $1,000, you don't have to file. If you've paid at least 100% of last year's tax bill, you don't have to file. However, if you're a high income earner, as defined by $150,000 or more of adjusted gross income, then you have to have paid at least 110% of last year's tax bill. And for married couples filing separately, that's $75,000 or higher. And finally, if you've paid at least 90% or more of this year's tax bill, you would not have to file this. So in part one, we're going to walk through calculations that will kind of match up with the questions as asked through this flow chart. So let's go ahead and begin. So in line one, we're entering John Doe's 2023 tax from his line 22 on his Form 1040. So let's say that was $5,000 based on this year's tax return. So we're going to make some adjustments. In line 2, we're going to include some of the additional taxes that you would find on Schedule 2. Examples, as pointed out right here, include self-employment tax, additional Medicare tax, or net investment income tax. There's actually a whole slew of additional taxes, all of which are reported on Schedule 2, and we do take the time to outline every one of those taxes that you should include in our article. So it's not a bad idea if you pull up the article as you're watching this video so you can at least take mental notes of what you should be looking for in your Schedule 2. This would go in here. And again, tax software is going to probably import all this information for you, but I do get a lot of questions from people that do this manually. In Schedule 3, in line 3, we're going to do the same thing with other credits and refundable or other payments and refundable credits as reported on Schedule 3. And again, if you go to the article, you'll see all of the different credits that may apply and links to specific articles that discuss those particular forms in more depth. So for line 4, we're going to combine all of these figures. We'll take the $5,000 tax bill, add the $3,000 of additional tax, and subtract out the $2,000 of credits, and we get $6,000. So if this number were less than $1,000, we could stop here and not file. Since it's $6,000, we have to keep going. So that's what we're going to do. In line 5, we're going to multiply the current year tax by 90%. We reach $5,400. Again, that's one part of this flow chart right here. So we'll have to keep going to see where we are. Withholding taxes. So other than estimated payments that you may either make through the IRS website or by filing the 1040V voucher with a check or a money order every quarter. Other than those, you would enter any taxes that were withheld from, that are reported to you on your W-2, any of your 1099s. So these would be withheld because you filed a Form W-4, W-4P, so on and so forth. So anything that is withheld from your income as you earned it will go here. Any of those discretionary estimated tax payments we're going to set aside for right now. So we'll subtract line 6 from line 4 and we have $2,500. So if this amount was less than $1,000, you could stop. You don't owe a penalty. Line 8 is the maximum required annual payment based on prior year's tax. So according to the instructions, you would basically take last year's tax. You would make very similar adjustments based on what we discussed in lines 2 and lines 3. And then you would enter that amount in line 8. And that would be the maximum required annual payment based on last year's tax. Again, if you are a high income earner, then you would have to make an additional adjustment so that this amount ends up being 110%. So now your required annual payment, you're going to take the smaller of either line 5 or line 8. In this case, that's line 8, so we'll drop that down here. Is line 9 more than line 6? In other words, is the outstanding tax more than what we paid with our withholdings? And in this case, yes, it is. So we would need to determine how much more we needed to have withheld. So in this case, we check yes, we might owe a penalty, but first we need to determine which one of these boxes in Part 2 applies. So in Part 2, we're requesting a waiver of the entire tax penalty. And in Box A and Box B, we're requesting a waiver, but we're selecting two different outcomes. So the IRS allows you to request a waiver for underpayment under one of two conditions. First, if you retired during the tax year or in the prior tax year because you were age 62 or older, or because you have a disability and you were no longer able to work, you can request a waiver as long as your underpayment was due to some sort of reasonable cause and not a willful neglect. And you would have to demonstrate that to the IRS. The difference between Box A and Box B is that in Box A, you're asking the IRS to calculate your penalty. You would not have to calculate it because the IRS is going to calculate it for you, and then they're hopefully going to waive it for you. In Box B, you're going to calculate the penalty, and then you're going to request a certain amount to be waived. You can request the entire penalty to be waived, but if you select Box B, that means you're going to put all of this in here. So in Box C, this means that you selected the annualized income installment method. There are two methods that you can calculate a tax penalty. Part 3, which we will go through, is known as the regular method. And basically, everything's divided into quarters. It's nice and neat. It's the calculation method that you would use if your income was evenly distributed throughout the tax year. However, in the back, Schedule AI exists for taxpayers that may get the vast majority of their income in one part of the year. So, for example, someone that operates a pumpkin patch might not get all of their income until the September-October timeframe, in which case you could go through Schedule AI and you could determine that you actually withheld the right amount of taxes based on when you received your income. So the IRS expectations are that you pay income tax as you earn the income, and this helps you, using Schedule AI, helps you properly communicate to the IRS that you were doing that. So most taxpayers who have seasonality or maybe a one-time taxable event like a capital gain after a huge sale may find that their penalty is either reduced or completely eliminated if they use Schedule AI. Now, we're not going to go through Schedule AI in this video. There is another video that I've created that walks step by step through Schedule AI. So we'll put a link to that video in the show notes. So if you did use Schedule AI, you would check Box C. Checking Box D, this means that your penalty is lower when you calculate that your federal tax withheld from your income was actually paid on the dates that it was withheld from your paycheck instead of in equal amounts on the due date. So, so you would have to calculate the penalty and then you would have to file Form 2210. But this is basically you going through every single pay stub instead of nice, neat quarterly payments. In Box E, you're checking because you filed or you're going to file a joint tax return for one of the tax years, but not both. And your line 8 right here is smaller than line 5. So you would calculate, you would file page 1, but you don't need to calculate your penalty unless one of these other boxes applies. So in this case, we're going to select Box B so that we can go ahead and walk through Part 3 on calculating the penalty. So in Section A, we're going to calculate the amount of the underpayment, and then in Section B, we're going to enter the penalty that we calculate on the worksheet located in the form instructions. So in line 10, we're going to go across all 4 of these columns, and the due dates for each quarterly payment are April 15th. So technically your first quarterly payment is due April 15th of the tax year, and not to be confused with the tax filing deadline for your prior year tax return. Column B, the due date is 6/15. In column C, the due date is 9/15, and then in column D, the due date is 1/15 of the following year. And then your tax liability, your tax income, or your income tax due would be the filing deadline, April 15th of the following tax year. So for line 10, we're going to enter 25% of the line 9 amount in each column. So we basically just take this amount and we're going to split it, divide it by 4, and we put those numbers here. Now in line 11, we're going to put the estimated tax paid and tax withheld. So now obviously this is a little bit different from the tax withholdings here. So suspend your belief for a moment. What I did was I wanted to kind of force a calculation of significantly lower tax penalty or tax payments so that we can go through all of the calculations that apply. So let's for a moment pretend that that line up there actually equals $1,500 instead of $3,500. There we go. So this is when our withholdings were. Now we're going to complete lines 12 through 18 of column A. Once we get down to the bottom of this, we're going to start with columns or lines 12 through 18 of column B. We'll go 12 through 18 of column C, and then we'll finish with rows 12 through 17 of column D. So in column A, you can see a few of these gray boxes, or these boxes are grayed out, so we'll go straight to line 15. So for column A only, we're going to drop down this amount from line 11, which we did here. And then we know that we have an underpayment because this $400 is obviously less than the $1,250. So we're going to subtract that. We get a difference of $850. So we're going to go to the next column where we only made $300 of payments for this quarter. We're going to add lines 11 and 12. Line 12 would apply if we had an overpayment in line 18 of the prior column. We have no overpayments in any of these quarters, so I'll go ahead and preface that by saying that there are zeros across the top. So 0 plus 300 equals 300. We're now going to bring up the 850 from up here. There's nothing in box 16, so it's just the 850. We'll put that in here. Now subtracting line 14 from line 13 results in a negative number, so we'll enter 0 here. If line 15 is 0, that means we have to now subtract line 13 from line 14, put in the difference here. So that's $1,250. So the amount of our underpayment for this quarter is the difference between line 10 and line 12, which is the entire quarterly payment. So I'll stop right here and I'll address the obvious question that comes up. If I paid $300 in this quarter, why is this in an underpayment? Shouldn't that be credited to the quarter? Actually, no. And we'll go through the details when we get to the worksheet, but this quarter doesn't get zeroed out until you see the total amount of payments add up to that $1,250. So through June 15th, it'll show that we've only paid $700 up to here. Okay. So, and then as of September 15th, we've only paid a total of $1,100, which is up here. So, and then, you know, we don't actually pay this off in full until we get to this quarter right here. And then we basically have $150 left over to apply here, which means none of these payments get applied to any of these required installments in columns C and D. So we're going to take this $1,250. That's the entire underpayment for the entire quarter. And now we're going to add lines 4, 11 and 12, which means that our total payment for the third quarter is $400. We're going to add that, we're going to add lines 16 and 17, so that's $1,800 here. And again, subtracting this from the payments means that this is 0. We're going to subtract the difference, and now we're underpaid by $1,400 so far. But for this quarter, it's only $1,250. So basically the prior 2 quarters. So now we're going to go back to the top of column D, and we're going to drop down this $400 to line 13. We're going to add these two. So now we've got a total of $2,650 of underpayment. So that means our underpayment for this quarter is $1,250. So now we're going to switch over to the instructions. So this is the penalty worksheet for Section B, or Part 3, Section B. This is where we calculate the penalty that we're going to enter down here. And this is going to be the part where you either appreciate your tax software or you hope that you didn't make a mistake. And that includes me too. So in line 1A, we're going to enter our underpayment from line 17 of the prior form of Section A. So all of these numbers will carry over up here. So I did these calculations in advance. So there is one slight. There's going to be a slight difference because in order, I'll explain these different rate period calculations. So for each period where there's an outstanding balance, so if the due date was, there's a rate calculation period between April 16th and June 30th. Right. So, and then the next one is July 1st to September 30th, October 1st to December 31st, and then January 1st through the tax filing deadline. So this isn't going to be 100% correct because one of the things that I did was I made these payments as if they were posted on these dates to coincide with these rate periods. So it's a little bit different than what was reported here in that, a June 30th posting would not have, this $300 payment would actually not have posted on 6/15. It would have posted on 6/30. So your tax software is going to account for that, but I wanted to acknowledge this mistake up front, because it's not going to be 100% correct. Rather, what I want to do is walk you through the calculation so that you can kind of do this on your own. So what this means is the payments that were made back here, 400, 300, 400, and 400, this is how they were applied. And let's just imagine that anything that was outstanding was paid on April 15th. So that's why you see these different amounts here. So we knew that we had a significant amount of taxes that had not been paid by January 15th. We just paid everything when we filed the tax return. So we're going to calculate the interest during these different rate periods based on the balances that were outstanding. So let's start with rate period 1. So there was, for this first quarterly payment, $850 that was outstanding, and the difference between April 15th and the end of June 30th, that's 76 days. The IRS instructions actually give you this table that you can use, and they also give you this neat little chart that kind of helps you do this. So I made this specifically so that we could walk through this calculation together right here. So, for example, if the due date of this payment was April 15th, but the money didn't post and get paid until June 30th, that means 76 days passed with that outstanding balance. Now, that's for the entire $850. So the calculation would be $850 times 76 days divided by the number of days in the year times the prevailing interest rate of 7%. So in this case, that amounts to $12.39. Now, had I posted this as if the payment was made here, it would have made these calculations a little bit more complicated because, we'll get to a point where these calculations end up being forced into multiple calculations in one rate period, and I felt like that was a little confusing for the video. So now what we will do is, after the June 30th payment, we go into rate period 2, in which case we still had this entire amount outstanding, except not the $850, it's now $550 because we paid $850 on June 30th. And now we have a $550 balance that we're carrying through until the end of September. And that was the end. That was a calculation that I needed to avoid having to make. So if we made this payment in June 15th, I would have had to calculate a 60-day or a 61-day rate period here, multiply that out, come up with a number, and then a 15-day rate period for the $550 example. So again, your tax software does this a lot faster than the human brain. So to avoid all of that complexity, I simply dumbed it down here, which means technically, that is not coinciding with what we posted in the form. So again, we're going to calculate the 92 days of this outstanding balance from July 1st through September 30th, based on $550. The prevailing, tax interest rate is still 7%. So this is $9.70. For the period of October 1st through December 31st, we've knocked out $400 of that balance. So now we have a $150 balance, in which case that $150 balance was carried for 92 days. We go through the same multiplication, except this rate period is 8%, not 7%. So make sure that you account for that. Every single rate period is going to look like it might have the same interest rate, but it might not. So you need to be very careful. And then because we paid it by December 31st, we don't have any interest that would have accrued after December 31st. We will get to a part of the form instructions where we will need to calculate that as well. So sorry, I'm trying to squeeze this in here. So in this case, rate period 4 not only has the different interest rate of 8% versus the 7%, we're in 2024, which is also a leap year, which means we're dividing by 366 days, not 365. So for the payment that was due on June 15th, again, the payment didn't even post until the end of December. So we're going to calculate, it was 15 days from the due date. So this wasn't due until June 15th. We have 15 days from June 15th to June 30th. We go through these same calculations and we arrive at $3.60. We're carrying this balance for the full month of September, so we have another $22.05 of accrued interest. We have, again, another full quarter, so that's $25.21 because of this difference in the interest rate. And finally, at the bottom, we're only paying interest on the outstanding $1,000, not the $1,250. So when we do that, we've got 106 days that we carried this balance from January 1st to April 15th, and that corresponds with $23.17 of interest. Similar calculations for both column C and column D, except column C is not due until September 15th. So we're going to carry the full balance for the rest of September, all of rate period 3, and all of rate period 4, because we actually don't even pay this in full until April 15th. So we get all of that. And then in column D, the due date of this was January 15th of 2024. So we have a slightly lower number of days where this is overdue, which means that this is a slightly lower amount of interest accrued here. And as indicated by all of these, if my calculations were correct, we should come up to $181.84. So again, odds are pretty good that one or more of these calculations is messed up. If it's messed up, please point it out in the show notes. Unless this wrecks the entire form, I don't plan to go back and record this video too soon. However, I do want to put any notes at the top of the comment section for people that might be watching so that they can avoid any calculation mistakes. Again, if you are using tax preparation software, you shouldn't have to worry about any of this. So let's go back to the form itself, where we've indicated $182 of interest. This would go on your Form 1040, line 38. It's a nicely hidden place. You can actually look at your tax return 5 times and skip over this every single time unless you know exactly where you're looking. So again, in this case, you would have a penalty of $182. But you know, if you made these estimated tax payments earlier, then you would be carrying an overpayment balance. So a quick illustrative example, I'm not going to redo the entire form, but let's just say that this was a $2,000, or sorry, let's make this $2,500. So if we carried the $2,500 down here, then we would have the $850. We can subtract the $850 from the $2,500, and that would give us $1,650. Oops. That would be 0. This would be an underpayment, and then this would be an overpayment, I'm sorry. And if line 15 is more than line 10, we would enter the amount of the overpayment by subtracting the difference, in which case that would be $400. You would then carry that $400 up to the top of the next column, so on and so forth. Okay, so that's how you would calculate the overpayment if applicable. And again, this form is designed so that if there's a net, overpayment in each column, then you don't have to file this form. So that was pretty exhaustive review of IRS Form 2210. Again, there's probably one or more calculation mistakes. Please point them out in the comment section. So we'll put links to the relevant articles and videos in the show notes. If you like our articles, please subscribe to our newsletter. And if you like our videos, please subscribe to our YouTube channel. And if you have any questions, comments, or if there's a situation or a tax form that you'd like to see covered in an upcoming video, please don't hesitate to hit me up. Thank you very much and have a great day.